Lesson 8. Debt and Equity. Borrowing capital allows you to invest and use assets without owning them outright, provided you can repay the borrowed amount with future earnings. However, borrowing comes with costs, so the asset must generate enough wealth, earnings, or savings to cover those expenses. Purchasing capital builds equity, while borrowing creates debt, each with unique advantages and trade-offs. Both approaches involve participating in the capital market to acquire the necessary resources for investment. You can acquire capital by offering equity to investors in exchange for ownership shares, giving them a claim on the future gains or income of the asset. Equity holders share in the benefits, such as wealth, income, or expense reductions, proportional to their ownership. However, they also bear proportional losses if the asset decreases in value. The cost of equity lies in sharing the investment's rewards. For example, in 2004, Google raised $1.67 billion by selling over 19 million shares, making the buyers shareholders with equity in the company. Founders Larry Page and Sergey Brin then shared Google's profits and losses with these shareholders. The cost of equity for Google is the return it must provide to compensate shareholders for waiting and taking on risk. Borrowing involves renting money for a set period, resulting in debt. During this time, interest must be paid as the cost of debt, and the principal must be repaid when the period ends. For borrowing to be worthwhile, the investment must generate enough earnings to cover the interest and grow in value to repay the principal, making debt a liability. In contrast, equity costs arise only if there's an increase in income or wealth and can often be deferred. Borrowing has a more immediate impact on income and expenses, as interest becomes an expense, and repayment obligations must be planned. Debt allows individuals to make investments or purchases, such as a home or car, that might otherwise be unaffordable. For debt to be worthwhile, the asset acquired must provide enough value, through increased income, reduced expenses, or growth in value, to outweigh its costs. While costs are usually clear at the start, the future benefits are uncertain, introducing risk. For instance, during the housing downturn of 2008, many homeowners found themselves owing more on their mortgages than their homes were worth. While the costs of their debt were predictable, the unforeseen drop in housing values highlighted the risk involved in relying on uncertain future benefits. Debt can also address budget deficits, where expenses exceed income. However, over time, the costs of debt, such as interest payments, add to existing expenses, potentially worsening the deficit. Without a corresponding increase in income, relying on debt risks deepening financial challenges rather than resolving them. Debt allows access to assets sooner, offering immediate benefits that would otherwise require significant time to achieve. For instance, young families often need a home with ample space for their children, but may not have saved enough to buy one outright. By borrowing through a mortgage, they can secure the home while repaying the loan with interest over time. This trade-off provides the asset when it's most needed, highlighting the practical value of debt financing. An alternative to buying a home with debt is renting, but this often proves more costly. Rent for a comparable home typically exceeds mortgage interest, because landlords aim to cover their costs and earn a profit. Borrowing to buy a home can be more practical, allowing you to enjoy the benefits of extra space for your children while they're still young and living at home. Waiting to save enough to purchase outright might delay homeownership until later in life, missing the opportunity to enjoy its advantages during the years they matter most. Debt can also be valuable when used to finance education, as it provides benefits that last a lifetime. One significant advantage is the potential for higher earnings. Educated or more skilled employees are typically in greater demand and can command higher wages compared to those with less education or fewer skills. In this way, education enhances personal value in the job market, making the investment in debt worthwhile when it leads to increased earning potential. Debt allows individuals to pursue education early, maximizing its value over a lifetime by enhancing income potential sooner. Borrowing to finance education enables you to use its benefits immediately, paying back the debt from future earnings. Waiting to save for education while working results in less efficient earning and reduces the time available to benefit from the higher income that education brings. Investing in education early minimizes opportunity costs and maximizes its long-term value. In the table below, you can look at the uses, value, and cost of debt. Debt creates a cost, but it reduces expenses or increases income to offset that cost. Debt allows this to happen sooner than it otherwise could, which allows you to realize the maximum benefit for the investment. In such cases, debt is worth it. In conclusion, debt and equity are two primary ways to finance investments, each with distinct benefits and costs. Debt allows individuals and businesses to access assets or opportunities immediately, with the obligation of repayment plus interest. While it can enhance value and income, it comes with risks, as the benefits are often uncertain while the costs are fixed. Equity, on the other hand, provides capital in exchange for shared ownership and returns, distributing the risk among investors, but also requiring the sharing of potential gains. Understanding the appropriate use of debt and equity depends on assessing the potential benefits of an investment, its associated risks, and the long-term implications for financial stability. Whether financing a home, an education, or a business, the choice between debt and equity should align with your goals and capacity to manage obligations, ensuring that the financing ultimately creates value and supports sustainable growth. See you in the next lesson.